We may be coming up to the Christmas break, but we have a huge week coming up from a macroeconomic perspective with the interest rate decisions from the Federal Reserve in America, the Bank of England and the Bank of Japan on Wednesday the 18th and then Thursday the 19th of December respectively. Markets think there's more than a 90% chance that Chair Jay Powell and the Fed will hand out a Christmas present with a 1/4 point cut down to 4.25%. It's seen as 50-50 whether Governor Andrew Bailey in the Monetary Policy Committee cut by 0.25% to 4.5% here in the UK. And markets think there's a 40% probability of an increase in interest rates from the Bank of Japan from the current 0.25%, as Governor Katsuo Ueda and colleagues look to normalise monetary policy after around 3 decades of ultra-low or negative rates and quantitative easing. Corporate news, well, that's scheduled to be a little bit quieter, although Hollywood Bowl and Kemmering are due to release results on the 17th, and Serco is set to offer a trading update on the 19th. Just the one FTSE 100 member firm is slated to update its shareholders, and that is support services giant Bunzl, where shareholders can look forward to a year-end trading update on Tuesday the 17th. Bunzl supplies the things other firms need in order to do business, but not items they actually sell to their own customers. For example, Bunzl supplies disposable coffee cups to cafes, food wrap to supermarkets, hard hats for builders, cleaning materials, bandages and rubber gloves for hospitals. The required nature of the product it provides may shelter Bunzl from the vagaries of the economic cycle, at least to some degree, and also provide it with some pricing power. That's no bad thing at a time when input costs and inflation remain a challenge, and it may help to explain why Bunzl shares trade near their all-time highs after a gain of nearly 1/5 over the past 12 months. This trading statement comes before the actual full-year results that are due next February, and it therefore won't feature a full set of accounts. Instead, this update will be viewed in the context of the guidance for 2 key benchmarks for 2024, provided by Chief Executive Frank Van Zanten, both of which he reaffirmed alongside October's third quarter update. The first is for, and I quote, robust revenue growth in 2024 at constant exchange rates, with a small drop in underlying revenues more than covered by the benefits of acquisitions. After 9 months, underlying sales were down 1.2% year on year, but underlying revenues overall were up by 5.4% on a constant currency basis, thanks to acquisitions adding nearly 7 percentage points to sales. On a stated basis, analysts are looking for broadly flat revenues for the year at £11.8 billion. The second bit of guidance, well, that's for underlying operating margins to increase moderately against 2023's outturn of 8%, with the result that adjusting operating profit shows a strong increase. Analysts have penciled in £985 million for this year and an 8.3% margin against £944 million and 8% last year. Bunzl may also update on its acquisition policy, where the company uses bolt-on deals to supplement existing momentum within the business, and also its £250 million share buyback that's running. A further buyback's on the cards for 2025, but the company is not likely to say much about that or its dividend until February's full-year figures. And the dividend is often a hot topic for Bunzl, even if the forward yield for 2024 is 2.1%, according to analysts' forecasts. The buyback pretty much doubles the cash return, by the way, but it's Bunzl's ability to grow its dividend which may catch the attention of investors. COVID-19 rather got in the way, but even then, the company quickly offered a catch-up payment in 2020, and Bunzl can point to serial progression in its distribution payment from 15.7p a share in 2005 to an analyst consensus forecast of 74p in 2024. Had it not been for COVID, I think the growth streak would have been 30 odd years by now. Bunzl's history suggests, therefore, that a growing dividend can, over time, if all goes well, help to drag a share price higher. Remember, Bunzl's share price ended 2005 at 638p, so the forecast dividend for 2024 of 74p a share equates to an 11.5% dividend yield on that. Now, Bunzl was a bit unlucky with COVID, but 20 FTSE 100 firms have grown their dividend every year for at least the last decade, with the investment trust Alliance Witam, the latest addition to this list after its promotion from the FTSE 250 this month. Spotting serial dividend raises isn't easy. 80 FTSE 100 firms haven't managed it over the past decade, and of the 20 that have, just 10 were in the index a decade ago. So it may be necessary to dig into the FTSE 250 or below to find the next generation, who will need strong competitive positions, robust balance sheets to help them generate the profit margins and cash flow needed to sustainably, consistently grow a dividend. The past is also by no means a guarantee for the future, but trend payout progress can help a stock, certainly looking at the numbers over the past 10 years. 20 serial dividend raises in the FTSE 100 have gained 176% on average, compared to 23% from the index. And those 20 have also offered an average total return of 244%, compared to 81% from the FTSE 100. 15 of the 20 have also beaten the index on a total return basis individually over the past decade, even if, again, we must accept the past is no guarantee for the future. Hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.